live from the city. This is the High Valuation Code with Matteo Turi.
Right. Good afternoon. My name is Francisco Gaffney, and welcome to episode 1 of the High Valuation Code Live. And this is the first session out of a 13 weekly cycles where we explore how businesses move from revenue to resilience and from resilience to premium valuation. And today we start with a difficult but important question. Why do profitable businesses still fail? Most organizations believe that if revenue is rising and profit is positive, they are safe. But safety is structural, and structure rarely appears clearly in the P&L. And welcome, Matteo Turi, a CFO expert. You have spent decades working inside companies at different stages, startups, scale, crisis exits. So have you seen this question? So have you seen profitable businesses collapse?
First of all, thank you very much, Francisco, for joining me on this journey. It happens so many times, unfortunately. This is a bit like something to demystify. The growing revenue means growing valuation. It couldn't be further from the truth, you know. I see this misconception really playing up so many times. And that's actually what led me to rethink how valuation is actually created. Because let's face it, you can have growing revenue, you can have healthy EBITDA, you can have a strong market demand, but you can still be fragile because profit is accounting. Valuation is actually so much more than that. It's structural confidence. I say profit really show you what happened, and valuation reflect what's likely to happen. And profit doesn't show you founder dependency. It doesn't show you undocumented risk. It doesn't show you capital structural fragility. It doesn't show you hidden intellectual property or governance gaps or funding gaps during growth. Investors do not fund profit. They fund confidence. And I've actually gone through, we are now in February 2026. I've already gone through 2 major case studies of businesses that have actually failed, total loss, total failure for shareholder, total failure for customer, total failure for jobs. And one of them was growing really very, very well at $3 billion sales. They had grown 20% every year for the last 5 years. They were actually listed on the stock market, believe it or not. And they just couldn't manage the funding gap. They had a $180 million funding gap. Now that's unbelievable to understand for many, but you can grow very well, no signal of failure, but then lack of financial intelligence will cause you to fail. And there was another example, a SaaS business, financial technology business, where the founder felt he was so invincible. He didn't need any CFO. And he grew 300% year on year to 1.2 billion. We're talking about big things here, yeah? And he had a funding gap of $60 million that he could not fund. And he went to Chapter 11. Now, my question is, how many small founders are silently falling and failing because they are not really looking for what they need to grow? Which is financial intelligence. So this is my experience so far in 2026, and we're still at the beginning.
So I think that this distinction here, which is critical from the governance and risk perspective, most companies are already acting on risk. So they, as you mentioned, they have controls, they have contracts, they monitor some metrics, but it's kind of informal, even if they are at that size. And when it is informal, it cannot be explained clearly to capital. So, and what cannot be explained is discounted, if you may.
Yeah, absolutely. What we tend to find is that these problems that cause failure or they cause lack of success, we can call it like that. They are usually very hidden. You don't find them in an historical report of an accountant. Absolutely not. And unfortunately, sooner or later they come to surface. An example is a founder-centric business where, for whatever reason, that happens a lot. Sometimes it's because founders feel intimidated by financial intelligence. They feel
Yeah,
that it will restrict what they do, they will take over their control, and they just confuse a very passive sort of function played by an accountant, which effectively is about an historical exercise. They tell you what happened,
right.
but they will never design your future. So
Yeah,
they will never tell you. I always say, okay, revenue will tell you, or profits will tell you what you've done, but cash flow will tell you the future. So that's a very, very common situation. I got so many case studies I went through, even in 2025, where the founder, left it too late before they actually called me because they had already one business that made £3 million sales, for example.
yeah,
They lost £450,000
right.
because they exposed themselves too much
Yeah.
with foreign exchange, for example. So it happens so many times. Yeah.
So that shows the fragility. So if we can put a concrete case here, for example, imagine a business that has a revenue of £12 million, an EBITDA of £2 million, and a growth rate of 30%. That on paper looks attractive. So, but where does the fragility here is hidden?
Yeah. Let's look back at your case study. So we're talking
Yeah,
about, let's say, revenue of £12 million, EBITDA £2 million,
yeah,
and growing at 30%.
yeah,
Now, the instant mistake people will make, they think EBITDA is like cash, your cash flow
right.
generational. Unfortunately, that could not be further from the truth. Now, I'll tell you this: each situation is obviously unique,
Yeah,
but in this particular scenario, I always say playbooks are really an illusion because real life experience will need to be considered. But let's say usually what happen, it's three different type of weaknesses that are difficult to spot
right,
until you just really dig deep. The
right,
first one is key person risks. One
right.
founder will drive sales, relationship strategy. Unfortunately, some of them, they will think they're invincible. There are
Yeah,
not documented processes. Yeah. So that's the first usual problem with that. The second one is capital engineering, which is very, very frequent. And usually is mismanagement of the working capital, mismanagement of capital allocation.
mm,
This is where founders, they tend to be intimidated by finance. They don't want to call finance because, okay, now someone is going to discover me. They make confusion between accounting and cash flow.
right.
A CFO is not an historian. Is a valuation designer.
Yeah,
No, this is typical, very, very typical, because growth increases working capital pressure. Earlier on
mm,
in my career, I've been in a business that went from $600 million valuation to zero
whoa,
because they make too many promises to customers. They were
right.
listed on the stock market, total loss. Number three, it's what I call it structural invisibility.
Right,
What I mean is the business carries no transferable value. There's no documented risk prioritization.
right,
There's no clear intellectual property narrative. So in actual fact, you are good at doing revenue today, but you're not going to be able to sustain it
right.
because you probably have just a temporary advantage.
Yeah,
Uh, you cannot answer a key question from an investor, which is, what do you own?
right,
Because most of the time, this is the key question that founders cannot really answer. What do you own?
right,
If you cannot answer that question, and if you do not carry value transferability, your business could be deemed to be worthless, even if it's growing, even if it's got revenue. Yeah.
right. And this is where structured risk thinking matters. I guess when we assess risk properly, we don't rely on instinct. So we score the impact, the likelihood, detection difficulty. That gives us a risk priority number. Then we adjust for time sensitivity, and some risk accelerates under growth. So without this structure, leadership is, I guess, is guessing most of the time, and guesswork becomes expensive. So Matteo, you often speak about the shift from CFO as a reporter to a CFO as an architect. So can you explain a bit more what is that distinction?
Yeah, effectively, I try to summarize this into an effort that many peers should do, and regardless of job description, really,
Right,
because a job description will tell you what is expected of you. But let's face it, businesses usually fail because of lack of financial intelligence.
right,
So that means we have a responsibility. Finance professional, we have a responsibility. We need to step up beyond job description.
right,
At the beginning of a company journey, finance just reports, yeah.
right,
So it closes books, it tracks cash, explains variance, but that is backward looking.
right.
A valuation architect designs forward, yeah. So what does he design? Well, he designs so many things. First of all,
Yeah,
the business fundability,
right,
then the business transferability. Now, these two things are very important for investor and for banks. For example, banks will not give you a good treatment if you don't do that.
right,
The next one is governance maturity. Again, if you're looking for, not necessarily if you're looking for funding, but also if you're looking to deal in a mature manner with customers, yeah? Your
right,
customer, they are what they pay you eventually, yeah? Governance maturity is underrated. Capital structure is, for example, working capital, which is a very typical situation. But what about capital allocation? What about anticipating before you need capital? Because let's face it, if you wait until you need capital, you're gonna have a very bad deal. You
yeah,
need to be able to anticipate, you know. You don't just want to look for capital in a rush, you know. Now, the other thing is exit optionality.
right,
Now, there are two words which are very important in business, which are very underrated when it comes to describing the strength or the weakness of a business. They are one the opposite of each other. The negative word is dependency.
right,
The positive word is optionality. Now, optionality is probably the most important word when it comes to investment committee, when you speak to an investor, when I speak to even a bank, or even speak to a customer, because
right,
you need to make sure that optionality is there. And most company, unfortunately, fell here quietly. I mean, in the evaluation journey framework, the first stage is fundability. There are
right,
several other stages. Most companies say, "Oh, we have numbers," but investors hesitate. Yeah, even banks hesitate. Yeah,
right,
why? Because the value logic is unclear. Revenue looks fragile. Risk is not documented. Intellectual property is not articulated.
right,
And one thing that unfortunately is so important in artificial intelligence driven economy, if your intellectual property is not articulated and your processes are not documented, unfortunately this is where your weaknesses will be even further sort of
scrutinized.
exposed. Yeah, exposed
Yeah,
because let's say many people they think, oh, ChatGPT is going to help me to do a better job. Yes, it will.
yeah,
Yeah. However, it will not increase your valuation because
right,
if your processes are not documented, if your intellectual property is not protected, artificial intelligence has got nothing to scale, first of all, and you are even going to be even more exposed because of
right,
artificial intelligence, because of your intellectual property is not documented, and someone
yeah.
is going to be able to copy it. Yeah.
Yeah, yeah, that's very true because actually today with AI, it's the boards is are struggling to understand how it is going to really work. And they implement that for the sake of it many times, rather than actually have a purpose for that implementation. And that is quite risky, because exactly to your point, valuation is not only about the earnings, it's about uncertainty reductions, like AI implementation. And also when risk treatments are defined, owned, measured, and documented, uncertainties start to reduce. So it's more palatable, if you may, for investor banking, etc., and funding. Obviously, the valuation also improves. Back to, if you don't mind, back to the comparing two versions of the same company, if you may. Version one is the revenue we mentioned, £12 million, and EBIT of £2 million. Is founder dependent, no board, informal supplier contracts, and reactive capital raising, no documented risk architecture, as you mentioned. What happens in that kind of valuations then?
Yeah, let's take two company with exactly the same number,
Right.
but a different valuation metrics that will completely change the
Yeah.
final number eventually. So version one, let's say again, as we said before, revenue £12 million,
Right.
EBITDA £2 million, but
Yeah.
it is founder dependent. There is no board. There are informal supply contract,
Yeah.
reactive capital raising, not documented risk architecture. Now,
Yeah.
what happens to valuation? Probably it will trade at 3 times EBITDA if you're lucky, probably even less, or
Right.
probably it will have zero value in some cases, because the buyers, they will see fragility, they will see no transferable value. Again, transferable value, they don't see optionality, they see dependency and not optionality. Okay.
Yeah.
Again, dependency versus optionality is a big test to be done all the time. So that's the first version. Maybe 3 times EBITDA. Maybe in the worst case scenario, it's worthless because it
Right.
just depends on the founder. Or
Yeah.
maybe they will value at founder's salary, which is a ridiculous number.
Right.
Now let's come at version two now. The same
Yeah.
company, again, revenue £12 million, EBITDA £2 million. But now we have something else. We have institutional governance. Okay, so we have some advisory, there's some real control going on in the business, some independent board advisory as well, or
Yeah.
just advisory. It doesn't have to be board advisory. Then we get a reduced key person risk, because the business probably does even less profit sometimes, but is
Right.
less dependability from the founder. Yeah.
Yeah.
Then we got a structure risk treatments. So we have a business that is actively calculating what is risking and is managing, is allocating capital in the right way.
Right. Right.
There's a clear capital stack, so the business is able to forecast the cash flow, is able to manage what happens with suppliers. There are formal supplier agreement. There are contracts that are managed. So
Yeah.
clear capital stack. The next thing, let's say you go IP monetization logic. Not
Yeah.
only not only you monetize your IP, but before you control it, you protect it, which is
Right.
fundamental. Yeah.
Yeah.
And then you go board credibility. Let's say if you go board credibility with the same revenue, now you're looking at 8 or 10 multiplier for EBITDA. So,
Right.
so let's say you go from an EBITDA of, say, from a valuation of 6 million, for example,
Hmm.
best case scenario previously, you go to an EBITDA of up to 20 million, 16 to
Right.
20 million pounds. The
Wow.
revenue did not change. The architecture did. So
Yeah.
that's the real that's what really happened with investors. Yeah.
Yeah. No, that's pretty much the reality. So what change structurally is very clear. So you can show why each treatment was chosen, how exposure changed, who owns the controls, what residual risk remains. So investor and boards trust clarity. So that transparency is very important, and they discount ambiguity, which is excellent. And but there also is a behavioral element. So many founders optimize for income. but investors optimize for optionality, as you mentioned earlier. So how do you reconcile that? Like when an owner seems to be going in that direction and investors are looking for another direction?
Yeah, I would say this. Obviously, you need income in a business. You need to be able to sell. Without top
Yeah.
line, the business does not exist. It's actually a prerequisite. Yeah.
Mm,
What founders should do is, and also I would say also this is a message for finance professional because yeah,
right.
this is about being a better finance professional for many. So income will sustain you,
Right.
absolutely, but valuation will free you.
Right.
Why am I saying that? Because a profitable but founder-dependent business will trap you. Instead, a structurally investable business creates option. Again, we go back to
Right.
that famous word, optionality.
Yeah.
So this is why, and I'll tell you this, obviously I want to introduce something because I'm actually publishing a book called Fail, Pivot, Scale. On the 1st of March is out on Amazon.
Right. Excellent.
So you'll find the link for that in this
Yeah.
chat. And obviously, I would like to encourage all the people listening here to click on the link and
Hmm.
also to read the synopsis. Now,
Yeah.
why Fail, Pivot, Scale? Fail, Pivot, Scale is not a slogan. It's
Right.
not a motivational slogan at all, actually. It's a cycle. It's a cycle we all encounter in our life.
Yeah.
And this cycle effectively creates with the high valuation code what I call a business that, if you manage this cycle well with the high valuation code, you will be able to to build a business that will be chased by three people who put money in your bank account. Number
Right.
one
Right.
is the customer, and number two is your investors, and number three is
Right.
your banks. So fail in this particular context is fail, recognize your structural weaknesses. Yeah.
Right.
So do it as soon as you can. Pivot. Pivot is redesign architecture decisively. And scale. Scale only once resilience exists in the business. Because if you scale without a structure, if you grow without architecture, you're
Mm.
actually accelerating towards fragility.
Yeah.
And architecture without growth is just theory. We need
Right.
both. So we
Right.
need growth and we need architecture at the same time.
Right, right, yeah, yes. And from a risk perspective, risk is not a negative all the time. So risk is exposure to outcomes, and threats reduce value. That's true. Opportunities increase value, but the treatment applies to both. So it's like the word that negative or positive is dependent how you approach them. When that logic is institutionalized, decision quality can improve, right? So if we can summarize this today, so a profitable business can still fail because the profit is accounting, valuation is structural confidence, and if your business disappear tomorrow, would it sell or will it collapse? And that is the lens we will use for the next 12 weeks. So just in terms of how we're going to come in next. So I guess that we can introduce next what will happen next week, why capital says so or why capital says no, even when the numbers look good, that we covered little today. And so this is an invitation for everybody to keep tuning in the next 13 weeks. We build towards deeper implementation. As Matteo mentioned, the book launches on the 1st of March. So the high valuation cohorts begins on the 8th of April. And probably we can explain what is a cohort. What is a cohort, Matteo? Just explain what is coming next too.
Yeah, thank you very much, Francisco. So basically, the cohort is a life journey that is gonna allow it's for founders and for CFO as well,
Right.
also finance professional and CEO as well, who want to move beyond reporting. They want to design valuation deliberately and create a build a business that again is chased by investors, it's chased by
Right.
banks, because the
Right.
high valuation code is based on three pillars that are really sought by investors, by banks, and by customer. And so that's the reason. So the cohort will effectively create 12 outcomes. If you want to click below, say cohort,
Right.
when you comment, I'll send you details personally. This is done really through invitation. Is not really done for everyone because obviously we don't want to have an excessive number of people joining because we want to really accept that each case is individual. So each business needs the time to be explained for 8 weeks. So the eight
Right.
weeks will start from the 8th of April and they will land at the end of May. So yeah, there is also a frequently asked question link that will be put there as well for you to read so you can understand exactly what this will do for your business as well. And obviously, you can
Right.
give me a call as well. I mean, you know how to find me on LinkedIn. So we'll send details personally. The reason why we do this valuation is such a misunderstood. I mean, I see this every day. I was speaking to
Right.
another founder the other day, say, "Oh, we don't need valuation now because we are not selling the business. We don't have anyone who is actually interested in looking at the
Right.
valuation right now." It's not a calculation on the spreadsheet. It's actually the result of many, many years of many decisions you made,
Right.
which you've done so many years before you come to evaluation. You have to build it on a daily basis. And the word architecture comes to mind because of that. It's really
Right.
architecture. You have to actually engineer valuation. So I'll
Right.
be very welcome. You will be very welcome to come to the cohort. Yeah.
Right. Excellent. So just to wrap up, so next week we are going to have why capital says no, even when the numbers look good. I think it's all related to why the cohort is going to be built around, like all the decisions that all from the past years to now. Why, even if you think you have a thriving business ready to sell, don't have the valuation that deserves or you think that deserves. And on the 1st of March, the launch of the book that fail, pivot, and scale. Right?
Okay. Thank you, Francisco.
Okay. Thank you very much. See you next week.
See you next week. Thank you.
Okay.
Bye.
Bye bye.